the Mitchell Markets. Today, I want to break down one of the most important concepts in technical trading, something institutions, hedge funds, and elite swing traders have used for decades, the 10-week line. But more importantly, I'm going to explain why my strategy is using the 50 EMA on the daily chart, how it acts like the 10-week line, why it moves better, creates more opportunity, and how I use it in real trading. This video will cover what the 10-week line actually is, how institutions use it, the real difference between SMA and EMA, and why I prefer a faster, more adaptive version of the same concept. The 10-week line is simply the 10-period simple moving average on the weekly chart. That's it. Each candle represents one full trading week, and the 10-week SMA represents the last 10 closings with equal weight given to each week. This is important. It's not an EMA, it's not weighted toward recent price. It's designed to be slow, stable, and reliable. On a daily chart, the closest equivalent is the 50-day SMA, because 1 week, 5 trading days, 10 weeks, 50 trading days. That's why traders often treat the 10-week SMA and the 50-day SMA as the same structural level, just on different time frames. The 10-week line is primarily a trend validation and trend continuation tool. Here's how it's traditionally used. In strong uptrends, price will often pull back into the 10-week line. If price respects and holds that level, it's considered institutional support. A clean break below the 10-week line on high volume often signals trend damage. This is why it's so popular with certain swing traders that are trying to stay aligned with institutional accumulation. Here's something most retail traders miss. Institutions don't trace breakouts the way retail traders do. They accumulate over time, use pullbacks and moving averages to add size, and care more about average price rather than perfect entries. The 10-week SMA gives them a stable reference point to manage exposure without reacting to noise. That's why you will often see the strongest stocks in bull markets ride the 10-week line for months. And that's institutional behavior made visible. Now let's talk about the key difference that changes everything. Simple moving average. Every period is weighted equally. Slower, smoother, better for confirmation. And EMA, recent prices, are weighted much heavier. Reacts faster, hugs price more closely, gives earlier signals. This weighting is not minor. On a 50 EMA, the most recent candle has almost double the influence as the 50 SMA. That's why EMAs turn faster, break sooner, and create more trade opportunities. Here's why I use the 50 EMA more. And the 50 EMA acts more like a faster, more adaptive 10-week line. Conceptually, it's the same idea. Midterm trend support, pullbacks and strong support, and institutions still respect it. But the difference is timing. The 50 EMA reacts sooner, adjusts to momentum faster, gives earlier entries and exit, and that means more opportunity with better risk to reward, with more tradable setups for active traders. And I'm not trying to wait weeks for confirmation on entering a trade. And that's why I treat the 50 EMA as my dynamic 10-week line. Strong trends, the 50 EMA often acts as first support. The 50 SMA often becomes secondary support. If price holds the EMA, structure remains intact. If it loses the EMA but holds the SMA, that's where institutional buyers are stepping in. And when both break, that's when trend damage becomes real. So to summarize, the 10-week line is the 10-week SMA, and institutions use it to manage trend exposure. The 50 EMA is a faster, more opportunistic version of the same concept, and that's why it's a core part of swing trading. Now we're going to take a quick dive into a real-life example of the 50 SMA 10-week line and the 50 EMA, my replacement for the 10-week line. So if you look at this range of about 3 months here, we're getting solid entries. The EMA 1, 2, 3, 4, 5 times before we break below both. If you look at the 10-week line or the 50 SMA, we are getting a breakthrough, another deep breakthrough, which are not actionable with proper stop losses. And then we are finally getting 1-2 solid actionable trades with solid risk reward. If you look at these, this is about a 1-to-1, again 1-to-1, again 1-to-1. You're looking on the 50 EMA. You are getting very actionable swing trading positions. And of course, you cannot just judge by looking at the 50 EMAs. That is not the case at all. I'm just trying to give you some knowledge for your toolbox and another filter to add on top of what we're teaching you here at Mitchell Markets for entering a position and knowing if there's proper support. For the 10-week line strategy, you're going to want a bull market. You're going to want clean support. You're going to want a stock that is continuously outperforming and showing great growth. That is going to be the best setup for the 10-week line. If you learned something, if you have any questions or comments, drop them below. Please be sure to leave a like and subscribe to Mitchell Markets, and I'll see you next time.